Hello, this is Steve Lentz with Discover Options. This is the Prepared Mind Report to determine the market likelihood from where we are today, April 3rd, leading into Monday, April 4th, 2016. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, you can go to the discoveroptions.com website. Click on the blog entry and see Frank Fahy's excellent entry here for this weekend. In that report, he gives us a nice list of stocks that are double calendar candidates. I think you'd want to take a look at that if you're at all into trading earnings. All right, these are earnings plays using double calendars. Let's go to the likelihood report now. Look at the SPX action. We see clearly an outside day on Friday, encompassing all of Thursday's price action. Thursday was a down day, Friday was an up day, so the price action is quite unique. The trend, we are above the 65-day simple moving average, and on the stochastics 15.3, we're clearly in overbought territory, way above 70 there. All right, so when you take a look at this very unique situation, the question here is since January of 2000, how often has this same scenario occurred, and what did the market do? You know, if you're an option premium seller, it'd be very helpful to know if the market typically, in that situation, typically went into a trading range or not, or if volatility ramped up and was much higher than the past. You know, if it's likely to go into a trading range, you might be a little more aggressive about doing your condors and butterflies, right? So that's what we're all about here with this report. And we get this information by using something we called edge analysis here. We look at the historical distribution of price. We look at the distribution of price after a scenario develops, like what we just saw. And then if the two are different significantly, we think that there might be a good tradable edge. All right, let's look at the historical distribution of price, and I'll walk you through this very quickly. What we like to do is look at volatility bands. Volatility bands. These are set one standard deviation from the close in 3 different time frames, 5, 10, and 15 days. We use a 20-day statistical volatility, others call it historical volatility, and these are log normally distributed. All right, here's an example. 10-day bands, okay, set from the close, 1 standard deviation level, looking at the volatility from the last 20 bars. The question here is price going to go up and hit the upper band, go down and hit the lower band, or wobble in the middle? All right, in this particular case, price rapidly went up, hit that upper band, as you can see. Oops, timeout. Right there we go, from here to there. Now, look at the close that we see there on the right, the final bar. Is price going to go up and hit the upper band, the lower band, or wobble in the middle? Well, if you look real carefully, price wobbled around. It tried to hit that lower band, close but no cigar. From there to there, you can see it was close but didn't quite hit it. It stayed in the middle. It hit neither of the bands. So what we do then is from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands for us to get a good handle on what the price distribution is. And so here's on the numbers. From January of 2000 through April 1st, 2016, you could see that on average it would hit the upper band roughly 29.7% of the time, the upper 10-day band 23.2%, the upper 15-day band 23% of the time. From any given close, it would go down and hit the lower band roughly 29.9% of the time, the lower 10-day band 29.5%, the lower 15-day band 32.3% of the time. That's over the course of 4,047 closes, going back that far. So that's the historical distribution of price. Now we're going to take a look at the distribution after our particular scenario developed. And what we'll do then is take this close, and we're going to take the exact same situation and go back in time, and you could see the same situation actually occurred, on Tuesday. All right. Uh, and we haven't had quite enough time yet to see if it hit the upper band there. It looks like it hadn't quite yet. Certainly not the lower bands were struck. The lower bands were not struck there. But there's just not a whole lot of situations like this going back that far, as you'll see. So we're going to look at the distribution not only from the close, going back at the, 20, 36 times that this occurred, but we're going to look what happened when price exceeded that day's high. As you can see in this particular case from Tuesday, price did go above. The next day, it went above the high of that bar. So in those situations where it goes above the high, we're going to look at the distribution then. We'll look at the distribution when price went below the low. All right, that way that'll help give you a better idea on Monday what to expect if price goes above the high or below the low. Here's the likelihood report. Okay, and you can see at the top we have the historical distribution here that we just went over. Just looking at from the close, we look at the percentages, and I added this little row here, which is the difference. So over the course of 33 signals, of those 33 times when we had the same situation develop, it would hit the upper 5-day band 12% of the time, 12.1, the upper 10-day band a little over 6% of the time, the upper 15-day band about 12.1% of the time. Far less than the historical distribution, and we put that difference right here in red. Now, on the lower side, it would hit the lower bands from the close, roughly about the same on the 5-day, a little bit less on the 10-day, less on the 15. Now then, if on Monday price exceeds Friday's high, all right, in those situations, there were 22 times when this occurred. Of those 22 times, it hit the upper 5-day band just, not even 5% of the time. It hit the upper 10-day band 9.1, the upper 15-day band 13.6. Again, far less than historical. All right, and if it goes over the high, we have again lower levels than the historical distribution. So, if price goes above Friday's high, it would appear then that we could expect volatility to be lower than what the historical distribution is. That price will fail to hit either of those, any of those 6 bands. Historically, it's hit those bands less often when this particular scenario occurs. Now, if it goes below Friday's low, when this situation is developed and it goes below the low, that's only happened 5 times since 2000. It's hard to believe. I know. But I brought up the chart. I went back and actually checked. Okay? And I counted them. 5 times is all that occurred. And you could see of all those 5 times when it went below the Friday's low, it never hit any of the bands of those 5 signals. Never did hit the upper bands at all. It hit the lower band a little bit more, just a tiny bit more than what the historical distribution is. Oh, excuse me, a lot more. But again, out of only 5 signals. So really, the difference between hitting the lower bands 2 times and 3 times is a big deal here. Okay, so I don't know how much credence you want to put in this. So that's kind of where we are using the statistical volatility. Now, for those of you options traders, all right, that like to really look at implied volatility, note right now that implied is slightly above statistical. On average, implied is above statistical in the long run. Recently, statistical has been above implied, but going way back for 6 years, you can see that the on average implied is higher than statistical. So what we like to do is recast these bands and use the market implied volatilities to determine the bands rather than statistical. And we like to look at both. All right, now because implied is generally higher than statistical, the bands are going to be wider apart. the volatility input is higher on average than statistical. So generally, the implied volatility bands will be wider, farther from the close. Therefore, price will strike them less often than the statistical volatility based bands. And you can kind of see that here. But generally, just look at the differences, okay, between the percentages and the distribution here. In this case, with our very unique setup, the upper 5-day band pretty much never gets hit, no matter what happens. So selling premium 5 days out, not that you'll get very much in this situation, but historically anyway, that upper band just historically has never gotten struck. You could see the 10-day band. Okay, even at the close, or whether it goes above the high or below the low, gets struck very, very seldom, as with the 15 days out on the upper band. The lower band, we have it getting struck a little bit more than you'll see on the upper bands. Okay, but generally, and then again, the 5, not that you can give much credence to that, but if it goes above the high, you have quite a bit of an advantage over and above what the historical is here. Okay. So I wish we had more signals to judge from this particular situation, but I hope this is kind of helpful. Now, one last note is if you were to use here, what I like to do is look at the statistical volatility here, down at the bottom of the sheet. The skew adjusted VIX is on the upside volatility is about 11.5. The downside volatility is at 14.7 about. So if you were to do a condor using those vol numbers on the calls with an 11.5 input, you'd be at the 2130, using week 4, the April 23rd expiration. Looking at the stats here from using a 14.7 input, you're down here in the puts at about the 2000 level. And when you analyze that, this is what you get for a skew adjusted condor, I guess. A skew adjusted 1 standard deviation condor would look something like this. And you could see if price does strike the sides here, the short strike, you'll lose roughly twice what you're trying to make. But when you look at historically how often these get struck, you'll conclude that there is quite a nice edge here. If the history plays out and the odds play out here in this case, that you're making 13% a lot more often than when you'll lose 26% when it does strike that. Okay, so that's it for today. We'll be back next weekend with the same report. Have a great week. Take care. Bye-bye.